Adjustments, deductions, and credits. Let's talk a little bit about the difference between gross income and adjusted gross income. Gross income is income before subtracting any adjustments. Adjusted gross income, otherwise known as AGI, is the taxable income after the subtraction of any adjustments. The standard deduction was increased in 2018 and will continue to be the increased amount until 2025 unless future legislation expands that time further. This is the deduction typically used by our clients. Itemized deductions are a sum of certain expenses, such as medical and dental, that exceeds 7.5% of the adjusted gross income, real estate taxes, personal property taxes, and state income taxes paid, home mortgage interest, gifts to charity, among others. With the increase to the standard deduction, as an example, this year it is $12,550 for a single taxpayer and $25,100 for a married couple. It would be difficult, if not impossible, for our clients to exceed the standard deduction by itemizing. The taxpayer may choose between the standard or itemized deduction. Only one of these can be used. The qualified business deduction is by formula and is calculated for us by TaxSlayer for clients who have self-employment income. This is deducted after the applicable standard or itemized deduction. The amount remaining is used to calculate tax owing. Refundable and non-refundable credits. Here are the differences between refundable and non-refundable credits. A refundable credit not only lowers the taxpayer's income tax obligation, it can also lower other tax obligations such as self-employment or tax on early withdrawal from a 401k or an IRA, and it can increase a refund. A refundable credit is an amount payable whether the taxpayer owes taxes or has zero tax obligation. Refundable credits are considered as payments made. Think of them as free money. Refundable tax credits are called refundable because if you qualify for a credit and the amount of the credit is larger than the tax you owe, you will receive a refund for the difference. Examples of refundable credits are the Earned Income Tax Credit, the Education Credit, the Additional Child Tax Credit, and so on. Some of these credits are expanded in separate training modules. TaxSlayer will calculate the amount of the following credits, but you still need to fill in pertinent information. You will find a list of these credits on page G1 in Pub 4012. The instructions for the following credits continue in that section. You should note, for 2021, the child tax credit and the additional child tax credit have been combined and recategorized as a refundable credit. In prior years, and unless expanded, the child tax credit portion was non-refundable, which meant it would go against any tax liability, but the additional child tax credit portion was refundable, which gave the taxpayers this extra payment whether they owed tax or not. Non-refundable credits are subtracted from whatever tax is owing. Non-refundable credits, which are large enough, can lower the income tax obligation to zero. It does not, however, lower tax obligations for self-employment or tax on early withdrawal from a 401k or from an IRA. You will find a list of non-refundable credits in Pub 4012, page G1. Here are just a few of the more common non-refundable credits we use at VITA. The credit for child and dependent care expenses and the taxpayer eligibility. There are certain tests that must be met in order to qualify for this credit. The taxpayer must have a qualifying person. They must have earned income. The expenses must enable the taxpayer to work. Some qualified work-related expenses include care for the qualifying person in order to allow the taxpayer and spouse, if married, to work or to look for work. The care includes services for the qualifying person's well-being and protection. Expenses to attend kindergarten or at a higher grade are not an expense for care. Expenses for summer day camp are qualifying, but those for overnight camp are not. Payments cannot be made to a spouse, parent of the child, another of the taxpayer's children, or anyone who can be claimed as a dependent. Married taxpayers must file jointly. They must be able to provide the name, address, and tax identification number of the care provider. Only the custodial parent may claim the child and dependent care credit, even if the child is being claimed as a dependent by the non-custodial parent under the rules for divorce or separated parents, because the child must live with the taxpayer more than one half of the year. Refer to your Pub 4012 for more information on this subject. Form 2441 is filled in for us by TaxSlayer, and the total credit is then moved to the 1040 Schedule 3, and from there it goes to the 1040 where it lowers the federal tax obligation. The provider must provide their name, address, and tax ID number, whether they were paid by you or if they were paid by your employer, with the amount showing in box 10 of the taxpayer's W-2. The credit for the elderly or disabled has eligibility requirements. The taxpayer must be over 65 at the end of the tax year, or they must be disabled. If they are disabled and under age 65, they will need to attach a copy of their disability papers to the return as well. It is dependent on the taxpayer's filing status and their income. This credit is calculated by TaxSlayer for us on Schedule R, with the total moved to the Schedule 3 and from there to the 1040 where it lowers any federal tax obligation. The Retirement Savers Credit, which is sometimes called the Savers Credit, helps to offset contributions made to various retirement accounts. It also allows taxpayers to make additional contributions, for example, in an IRA or a Roth IRA up to the tax deadline, which for this year is April 18th, 2022. Here are the rules for a taxpayer to be eligible for the Retirement Savers Credit. They must be age 18 or over. They must not be a full-time student. They must not be claimed as a dependent on another person's tax return. They must have adjusted gross income that meets the current year limits. TaxSlayer will calculate this for us on Form 8880 and move that total to the 1040 Schedule 3. From there it goes to the 1040 where it again lowers any federal tax obligation. The child tax credit changed for tax year 2021 only. Here are the conditions that must be met in order to claim this credit. They must be under age 18 at the end of the tax year, a U.S. citizen, national, or resident alien of the United States. The child must be claimed as your dependent. It can be your son or daughter, adopted child, stepchild, eligible foster child, or a descendant of any of them. A brother, sister, half-brother, half-sister, stepbrother, stepsister, or a descendant of any of them, for example, your niece or nephew. They could not provide over half of their own support. They must have lived with the taxpayer for more than half of the year. They must have a Social Security number that is valid for employment issued before the date of the return, including extensions. No ITINs. There are special rules for divorced and separated spouses. Refer to your Pub 4012 for more information. The expanded child tax credit means the amounts of the credit for qualifying children will increase for many taxpayers. For eligible taxpayers, the credit is fully refundable, which means that taxpayers can benefit from the credit even if they don't have earned income or don't owe any income taxes. As an example, parents who only receive Social Security now qualify. Taxpayers can receive the credit for qualifying children who turned 17 in 2021. This is a change over last year where it was 16. Eligible taxpayers may receive part of their estimated credit in 2021 before filing their 2021 tax return. For tax year 2021, families claiming the child tax credit will receive up to $3,000 per qualifying child between the ages of 6 and 17 at the end of 2021. They will receive $3,600 per qualifying child under age 6 at the end of 2021. Under the prior law, the amount of the child tax credit was up to $2,000 per qualifying child under the age of 17 at the end of the year. Credit for other dependents. Because of the elimination of exemptions as we have known them in years past, a $500 non-refundable credit was created to aid taxpayers whose children are age 18 and above, as an example, college students, or if the taxpayer supports any other person. Another example would be a disabled relative or a parent. As an additional note, a qualifying relative in this case does not necessarily have to reside with the taxpayer. A parent who has their own apartment but receives more than half of their support from their child would still qualify as a qualifying relative for this credit. One qualifying person can only be used for either the expanded child tax credit or the credit for other dependents, not both. Here are the rules for claiming the credit for other dependents. The dependent must be a qualifying child or a qualifying relative. The dependent can have either an SSN or an ITIN. The dependent must be a United States citizen, national, or resident of the United States. Your Pub 4012 will be very helpful in determining if a taxpayer qualifies for these credits. TaxSlayer automatically calculates these credits for us. This information is very helpful when doing the quality review. If you expect to see one of these credits and do not, it may be because of the non-refundable issue.